So, why don't most people end up rich? Why do most people end up as the struggling 99% and others end up as the 1%? Uh, is it education? Is it IQ? I would actually argue that it's principles and temperament. With the word principles, you should immediately think of Ray Dalio, and with the word temperament, you should immediately think of Charlie Munger. And I had an interesting interaction yesterday with others who invest in financial markets. And I won't use the term really investors, I would use the term traders, I guess. Um, and it just makes me realize how different I am from most people who invest in financial markets. And how this difference, I feel, has what's led to my success in financial markets and others just doing okay or struggling with the same knowledge, the same software, so on and so forth. And um, for me, really, it comes down to having a long-term view of financial markets and identifying as an investor, or having a short-term view of financial markets and seeing myself as a trader. Jack Bogle wrote a wonderful book on this subject. Highly recommend it, called "The Clash of Cultures: Investment Culture versus Trading Culture." And in this particular instance, basically, there were people that were up in arms that a particular software you weren't able to liquidate for 2 hours during the day. There was a period, there was a glitch due to a stock split. And in my mind, I'm thinking, really? Like, is that such a big deal? Because again, and again, sitting back and having introspection, seeing that that's not how I operate. That's not how I made millions of dollars. And that's not how I'll take my millions from seven figures into eight figures, by liquidating at the open, or uh, creating a symphony that's designed to exit the market on certain things, but then at the first sign of distress, panic sell that symphony, liquidate everything, go to cash. It's funny when you read the book, I believe, "The Man Who Solved the Market," on Jim Simmons, Rentech. At the end of one of the chapters, they talked about December 2018, when things weren't going well at Rentech, and some of the younger engineers came in and wanted to abandon the algorithms, and they said no, and they stuck it out, and everything worked out. And so, yeah, I just think, again, when you're looking at the mountaintops instead of in the weeds, you're going to end up with a much bigger pot of gold than those who are just wandering around in the weeds and, oh my God, it's this happened today, so I'm going to abandon all logic and all rules-based system of investing. And someone might be watching this saying, well, you're a hypocrite, or it's counterintuitive to me, because this is, these things trade every day. So if you're really a long-term investor, you're not, because these are trading on a daily basis. And what I would say is, I view these symphonies here as systems of investing, rules-based, logic-based. So when you're constantly liquidating at a whim, again, what's telling you to liquidate? And then what signal is telling you to get back in? Your gut? What you had for breakfast? Your neighbor? Really? So again, you're abandoning a rules-based, logic-based system for your opinion. You might as well not even have a. You might as well just own TQQQ and then liquidate at the open if you feel like it, and then re-enter when you feel like it, and then maybe look at your astrologer and see what they have to say. Maybe I'll be a little harsh. Maybe, I don't know. It just, again, what it does is it clarifies that I don't have much in common with other investors, and I would argue that the fact that I don't have much in common is why I've had the success that I've had. Right? That sense of isolation and going against the crowd is due to the success. So so I just kind of wanted to go over that and just touch upon that. Just have a couple notes on it here. Some things I wanted to mention, and so for me, regarding these symphonies, for example, I see them as the way I view them as a form of index funds or mutual funds again. So it's not like I'm going to jump in one for 3 months. And it's why if you look at a lot of the ones that I've edited, removed many single stocks and replaced it with index ETFs because I want this symphony to be valid in 2035. And I feel it's less likely to be relevant due to the brutal nature of capitalism and how individual companies come and go, come and go. Again, look at the S&P 500 list from 2010. Look at it from 2000. Look at it from 1990. Individual companies come and go, but that SPY, that VOO is there. And so again, I like to, because I have that longer term view, and here's and I used this yesterday in the discussion. This is a Buffett quote here. Let's bring this down. I never attempt to make money on the stock market. I buy on the assumption they could close the market the next day and not reopen it for 5 years. And again, 5 years to me is maybe a little much, but basically the point is that's how I allocate to symphonies. I allocate to symphonies that if I lost my composer username and password for 5 years and I never logged back in, that I would have stellar returns. In fact, I would argue this. I would argue that on this platform, Composer, that it's not the builders who are going to make the most money from things that they've even built themselves. Because if the builder has a bad temperament and can't withstand volatility and it has the shiny object syndrome, he's not even going to own his own symphony for any length of time. He's going to be creating a new one. That's the flavor of the month. And so I would argue that someone who allocated 2 years ago and forgot they had a composer account might end up having a higher CAGR in 2030. Again, maybe I'm wrong. Time will tell on that. And it actually started because it was initially, I think it was confined to IRAs, or people thought maybe it was confined to IRAs. And, I manage an IRA and composer. For me, that money, I allocated it. I don't need to log into that account until January 2nd, 2025, simply to execute the RMD. And especially retirement account. Usually retirement accounts are generally in culture considered sacrosanct, more so than taxable. That because it's a retirement account, that people aren't YOLOing retirement accounts and buying, selling in a retirement account. Now, you could argue that it's actually the place to do it because it's more tax advantageous. That's certainly an argument one could make. But generally, when you speak with financial advisors, when you speak with investors, they're going to say, like, listen, your taxable account, maybe you want to allocate this 10% or this 20% for a little more aggressive, a little more risk. But your retirement account, you should definitely not gamble with, not day trade with. So that's another level that it was like, not only was it at 2 hours, but it was 2 hours within a retirement account. It actually makes me think of an interesting Jack Bogle story. The founder of the ETF walked into Bogle's office and wanted to offer the ETF to Vanguard, and Bogle turned it down and absolutely said, I hate this idea. It's exactly what I don't want Vanguard investors to do. I don't want them to be able to access their mutual fund during a market hour, during a 2%, a 4%, a 5% sell-off, make a decision based on emotion, based on fear. I want it to be difficult for them to be able to have to access this and, through a mutual fund product instead of an ETF. And in fact, it took Vanguard many years to catch up to others in the ETF space simply because of Bogle's distaste for ETFs. Now, you could argue against that. You could say that he missed an opportunity. You could say that he's a dusty old man who didn't know what he was talking about. You could level all these things against Jack Bogle for that belief. But the point that he understood is that, and it goes back to a Fidelity study. Fidelity did a study. Dead people and people who forgot they had accounts were their highest performers. Not people who studied charts, not people who had CNBC on one TV and Bloomberg on another TV and TradingView and 17, 18 computers. dead people, people that forgot they had accounts. So the point is that oftentimes you, as the investor, are your own worst enemy. And just one other point here that I wanted to make, and it related to max drawdown. Okay. So there was, I believe, a passive aggressive snarky comment regarding the max drawdown of this fund. Okay. Let me show you here. So this fund, it's been running since, I want to say, January 17th. Yes, January 17th. So let's grab my little calculator here. So let's take just today, it's at 574978, right? You see that now it's 26. I'm just gonna take that number. Let's do it here. 574726 divided by 5,000 minus 1. So it's compounded at 14.9. Let's say 15%, 14.9, 15% in several months, by the way. So we're, almost less than 3 months. And someone made a snarky comment about the max drawdown of 24%. Well, when you look at this, you might think, okay, so that means that basically at one point, 24.3, let's see here, that it would have been about $3,700 or so. If you take 5,000, 24.3%, okay, so 1215. Yeah, 37.85. This fund has not been underwater for a single day, which means it's never crossed under this 5,000 number. And so you might be like, well, what are you talking about? So let's say the fund at 5,000, it went up 50% or 40%. And then it's come down off of those highs, 24%. Okay. But you were never underwater. So it's like people in NVIDIA. It's like people bought NVIDIA and it's run up. And sure, recently there's been a pullback of, let's say 10%, 15%. But really, you're still up tremendously on the investment. I mean, you see the annualized here. So this fund, I'm up 15%, and I haven't ever been under this threshold, which is the point I'm trying to make. So, and again, it makes me think of a Buffettism, if you will. I'd rather have a lumpy 15% return. And it's funny that it's 14.9. It's almost as if the investing gods willed that to be. The quotation is, I'd rather have a lumpy 15% return than a smooth 12%. So if you said to me, oh, instead of this being 57, let's say it's 5,300 right now, but this number was 5%. What would you rather have today? Would you rather have that smooth, return from 5,000 to 53 or 52? Or would you rather have, a 15% return here under 3 months, but have it where it was very lumpy, where, you went up, let's say 30%, 40%, 50%, 60%, but then came back down. So that's an interesting distinction that I don't think a lot of people make. And so when you're looking at something like max drawdown, definitely for me, again, maybe people don't see it this way, and that's fine. I'm not a missionary. I'm not here necessarily to convert you to my argument, to convert you to my sensibility and mannerisms. It's just simply a self-expression. This is how I do things. These are my results. I've done quite well. And so that's pretty much it. Just wanted to kind of share that. We can do like a quick portfolio check here before I sign off. You can see big day here. Recovery, almost up 3%, 9% for the year. That's right around tracking with SPY. Maybe slightly under, but it's around that range. And I was tracking it for most of the year last year, and then it was really at the end that I pulled away. But if you take 316,000 minus 290, so I'm up over $26,000 year to date in Composer, and Let's take it here, and you can see this. It's actually even a little bit higher, up about 4,000 today. And then for year to date, so if you take the 26 plus 37,949.05, so up about 63,000. You also want to add, and I kind of just logged out. That's fine. It's also about another 4,000. So it's probably about 67. It's funny. I had this pulled up. I was going to mention this. I didn't, but now that it crashed here's the Buffett book I mentioned. But you might think, why would I have men are from Mars, women are from Venus pulled up? And that's kind of, and I'll end on this, the sensibility that I see between investing culture and day trading and speculation and culture. That I see myself investing. I'm on Mars and they're on Venus, or I'm on Venus, they're on Mars. It doesn't mean that necessarily one is greater. Again, you could take someone like, and I mentioned two kind of popular YouTubers, because younger people oftentimes are more interested in trading, like a Lambo Raul, who's a multi-millionaire, Umaref, who's a multi-millionaire. I'm butchering his name, I'm sure. Ashraf, I think his last name is. And then there's Benjamin Graham, David Dodd, Warren Charlie, Monish Pabray, Guy Spier, Peter Lynch, fundamental value type investors. So there it is. That's just my 2 cents on this. And, we'll be back continuing to do portfolio shares. But yeah, up anywhere between about 64,000 to 70,000, because when you add the value of the short option premium, so flirting with about 70,000 for the year. Amazing start. Very happy with it. So that's it for now. Take care. Ciao.